All right. Let everybody get in here as usual. And we are live. Let me get this shared out. What's up, Will? All right, into the Slack. And I'm not going to send it to my mail list today. I feel like I'm flooding them with too much. We got it for your wife, obviously. Good morning, Mrs. B-Side. And the B-Side crew, 4-year-old and 1-year-old in here, getting ready to go. Building traders. How cool is that? How cool is that? All right, we're live. And let me share my screen, actually. What is up? For those of you watching live, welcome. I'm not wearing a hat today because coronavirus is why I've been wearing a hat, but yeah, I decided to do my hair. All right, let's share the screen. Okay. And we'll just wait for everybody to get in here. So let me find another, there we go. Okay. All right. You know, I would love a little background music today. Put that over there. All right, yeah, we'll just wait for a few people to join us here. I'm sure we're on a steady live normal time. What date is it? I haven't worn my watch in, oh, that's 8. Okay, so we're 8:30. I haven't worn my watch in like a week. It's 8:30, not 7:30. So it died on me. So got to kind of wind it up and reset it. It's a day off times. I figure, you know, I'm just sitting at home and I might as well use my wife's Apple Watch to start collecting data on what I'm doing. I had a Garmin band that I was using. I just thought, you know, the Apple Watch is actually a better sensor. So I started using that. It's pink. Looking for an exit on pound Kiwi. Yeah, let's look at, it was a good setup. I was watching Kiwi yesterday, so 240. So you're short. So it's Mrs. T. Good morning, Mrs. T. Watching with a wife and 5-month-old. All right. Well, we're going to be broadcasting here in the next few weeks with, I don't think wife will make it on, but certainly the 1 day old might make an appearance. I don't know if I'll make it to get on live streams, but what is up, Mrs. T? What is up, AT? What is up, young T? That's cool. That's cool. That's very cool. So yeah, you got yourself on a 4-hour. Oh, you got long. So you took the failed vol breakout yesterday to the midline. Is that what you did, Will? Or did you get short on the break below here? Either way. Let's look at US. So I still haven't updated my my subscription with TradingView. And honestly, I realized how little I actually use the futures. So I started to just do the CFDs, which I'm paying for, or are free or whatever. And I saved like probably $130 in subscriptions on data feeds that I don't need because I'm not trading them. Maybe I'll add them back. But yeah, so I start just digging in. Let's have a look at. So I put this out yesterday on Twitter. And basically, fuel for a blow-off rally needs 2 things. Bear stop loss on shorts. So what's happening here is, 1, bears put their stop loss like above here. So if they've gotten short anywhere in here, the more aggressive bears are going to have their stop anywhere above, especially after this move and this came down. A lot of them probably took this short. I think we talked about it. I don't know if I talked about it was it on Twitter or in YouTube, but that was a 1.5 hour short we took or we called out. And bears might have stuck with it. They would have had to put their stop to break even or above here, expecting something bad. Now they pierce, and then that big reversal yesterday signals low 26.31.1, 26.28. So bears could have actually gotten short here, and now they're eating all this up. So one thing we really got to have is you got to have a lot of the bears getting stopped out in this general area. That's going to have buying that's going to fail and blow off, like we had yesterday's big. That was a big move that failed and reversed and closed at the bottom. That's a shooting star. It's a very bearish candle pattern. Okay. And it's telling us something. If it fails, that's telling us that this thing is actually very, very strong, much stronger than we thought. And we're going to be off and running. Okay. If it does trade down, even if it's just, down 1.5R or 2R, down into this range, that's a confirmation that things are working. But if this thing goes higher, if this beautiful sell setup bear regime fails and we go higher, that's indicative of what market regime? The bull quiet, where the best looking sells in the world, the best looking shorts in the world fail. And that's telling you that bulls are still in control. And so, we could end up for, multiple legs higher. We could end up turning down. Now, this bear stop loss on short. So that's happened already. Now, the next thing is we're going to look to see bulls who sold this first. So, okay, let's say you added to your 401k here because holy crap, we've missed out on so much. And this thing just doesn't stop going up. It just keeps rising and rising and rising. So you add another 20,000 to your 401k, and then this happens. And then you call, actually probably somewhere around here. Then you call your son or your son-in-law or whoever it is and say, hey, I just added 20,000 or I just added 20,000 in here. Should I add another 20,000 to my 401k or my retirement or my account? Because buying the dip has worked forever. And if he's like me, he says, no, something different is happening. Just stay cool. And then they call again down here. Oh crap, I'm going to sell on the first bounce. This is worse than I thought. You were right. And then this first bounce happens and they're like, okay, whew, I'm out. And then it turns down. They're feeling like a genius. And then it starts moving again. And they see the headlines up another 2.5% today. What are you thinking's going on here? They're going to FOMO in. They're going to think, okay, cool. I sold everything down here. I thought we were thought the world was going to end. Coronavirus was going to take over the world. And I thought this was worse than any further or any previous bear market. Oh no. Oh dear God. And then, so they sell only to realize that now they're going higher and they're like, oh crap, we actually want to buy these things. Remember, we're supposed to buy the dips. We've been buying the dips all the way through. It's worked for us. So let's just keep doing it. And so now they start FOMOing here, thinking that they missed that buy of a century, which is, not really the buy of a century. And then that comes up. And then if that fails, they're going to be the sellers. So they're going to have gone through all this, gone through this, sold first, and then bought again, chasing. And if it goes down, they're going to be the aggressive sellers. So they're going to be the ones who've been so conditioned to buy the dip. And if it goes down, they're going to be selling really fast, which is going to bring the bears to jump back in short, which is what kind of happened yesterday. It's exactly what we had yesterday, a blow off top, a sell signal that gets filled, and we could do another failed breakout, which is up here, a tick above this, making people feel pretty smart about themselves, and then that subsequent sell off. Anyway, so that's how we get this blow off top. If that starts happening, we start going down, bulls are going to sell off again. That's going to accelerate down. And then bulls who didn't sell already are going to get a lot more scared and they're going to sell everything. And that's where you break the 2000 level or whatever, some magic line. Okay. Let's have a look at Will's trade. So short, it looks like. You got short that was basically the trade I was looking at. I actually was looking at I was looking at this one on the daily long yesterday, without the lines. So basically it came down, we had that low, had a reversal, so a possible trade up to here, it would have gone, and it's at the bottom. So just Kiwi had some stuff going on. So let's look at the trade that I was originally getting set up with, which is okay. We're in. So you remember yesterday, if you guys came and watched, so yesterday. And this is a great lesson. This is a great lesson in why we use buy stops. So on bonds, we're in a bull quiet regime. It's trading similarly to a bull quiet regime. That was definitely a bull volatile, but we've tamed it down a bit. And so what do we know about bull quiet regimes is we just want an excuse to be long, right? You want to be long, you want to buy pullbacks. In the first stages of transitioning back to a bull quiet, you want to buy pullbacks. As it becomes a little later stage, then you want to start looking to add to your breakouts. Okay. But so what we're having here is we had a nice reversal candle yesterday, a hammer in an uptrend in a bull quiet. So what we do is we put a buy stop a tick above yesterday's high. What does that mean? It means we have to trade above yesterday's high to actually enter the trade. So it's not a limit order. We're not putting a limit at some magic line that we think it's going to break at. We're going to let this thing trade in our direction. And that's an important distinction, because if it doesn't pull you into the trade, you don't need to be in the trade. It's very simple. So we're just sitting on that one. So the order's still resting to get long here. We could have another reversal day like we did yesterday, big up day in equities, followed by a sell-off. And if that happens, we could actually get filled long and head up. Otherwise, we would just adjust our entry to here after today's trading. Does that makes sense? All right. Turn off my music. And check one thing. All right. And I am going to do a quick one. So those of you on the email list, welcome. If you guys got any questions, go ahead and throw them in the chat. I'm going to cover the two different strategies and the difference between. All right, I'm just going to send that out real quick. Ooh, a little warmer in here. I'm going to put a fan on real quick. Give me a minute. There we go. That's a little too fast. Okay. So the difference between the two, this was and I sent this out in the email yesterday. If you're not on the email list, make sure you guys have this. All right. So if you don't have the daily email list, you're not getting our daily emails. It's go to christover.com and get signed up. So let me just I'm gonna throw this on both actually. See if it'll copy over. It will. Okay. So as you can see, we have two different trades here, two different strategies. This is a back test from 1962, trading the S&P 500. And this is a back test of 2008, trading the 2007 to 2009, trading the S&P 500. So you can kind of see that this looks similar on that, but this is a daily chart trading bear volatile, bear quiet regime, short only, vol breakout and failed vol breakouts. And this is the hourly chart trading vol breakouts. And let me make sure it's just bear volatile, vol breakout. Okay. Oops. So this is bear volatile regime and vol breakout strategy on an hourly chart only. This was more of being able to understand that you're in a bear market and trading the daily charts. So the thing is, and I put this out on Twitter, I said, and it was actually like this. There we go. Put these back, but this was option one and this was option two. What would you rather trade, option one or option two? I think that's how it went. Let's have a look. Yeah. Which would you rather trade? And It wasn't a trick question, believe me. I was just curious of what people would actually be interested in trading, right? Like if you had the option to trade a strategy that looked like this, would you rather trade this strategy? Or if you had a strategy that had returns that look like this, would you trade this strategy? And most people thought it was a trick question, and people were hesitant to make an answer, and they were, you know, like, oh, it's one of the same. It's all it's so let me just clarify. This is a 1 hour vol breakout trading on the hourly charts, the S&P 500, 1 hour charts, vol breakout only. This was daily trading the vol breakout only in bear regimes. Okay. So what I'm trying to get at here is in a bear volatile regime and bear quiet, actually, the shorter time frames, the hourly time frames, far superior returns than sitting on massive short positions. Okay. So for the trading cohort, for people who are flat at the end of the day or are in and out on short-term timeframes, you're trading the vol breakout strategy in bear volatile or failed vol breakout long only in bear quiet and vol breakout long only in bear quiet. These are the sort of returns that you're going to get right in here. And let's show you what that looks like. Oh, these are, why are these empty? I don't understand. Anyway, these should have been, for some reason, all these are empty. I must have swiped it. We have it somewhere else. Anyway, okay, let me put it this way. How many people do you know who are perma bears who have this massive euro dollar type strange future currency option trade? How many people have massive puts, out of the money S&P puts 2 years out? How many people do you know have these really big complex type portfolios that are short and looking to be short and sitting short and not getting out? They're waiting for the world to end. They're waiting for a 60-70% drop on the S&P. They're waiting for mass apocalypse. And so if you're thinking that, then if you have that sort of strategy, if that's what you're doing, you just have these massive puts and just you're super bearish, you have all these bearish everything trades on, and you're holding them, waiting for huge amount of downside. This is what happens. This is what your strategy looks like. It actually works very poorly. And in the email, I went and put a bunch of characteristics about what the bear market regimes, whether bear volatile or bear quiet, actually looks like and what we trade. So if you follow me before and we were in the bull quiet regime, remember it was just be long at any excuse to be long. So any pullback, you're buying. Any breakout, you're buying. Anywhere. If it's a Monday, you're buying. If it's a Wednesday, you're buying. So the bull quiet regime, the characteristics of that bull quiet regime tell you to just be long. Now, when you move into bull volatile, the top end of it, the blue, let me show you. Let's just get to the S&P. So US 100, that's the NASDAQ. Well, that's fine. As you can see, this is on the chart. This is a bull quiet regime. Any reason to be long, any reason at all from that would have been the beginning of November. Basically every dip could have been bought and you just ride it all the way up until we move into a bull volatile regime, which is here. And that's when you just sit long here. When you get into this area, or you day trade these things, however you want to do it. But for the most part, it's always long, whether you're buying the opening dip and day trading it up, or you're just buying on a Monday because it felt like you bought and you ride it out. But when you get into bull volatile, that's when you're saying, okay, now I need to be clear. You need, in order to have a market top, the requirement using this quantitative strategy is you have bull volatile. So a true market top does not happen in a bull quiet regime. So a lot of people get scared in here, and this is the wall of worry. And this is where people start getting really snarky and angry on Twitter about buy the dip and blah, blah, blah. It's because it's just low volatility, nice, easy rises. You know, this was a 0.64% up move, 0.3%, 1.2%. They're just simple up moves. Yeah, you pull back. That's fine. Yeah, you have pullbacks, and then you add to positions. But as you can see, in a bull quiet regime, you just want to be in there. Now, in order to have a market top, this does not mean just because we get bull volatile, that doesn't mean that you are going to have a market top, but it's a requirement to a market top. Okay. So a true market top happens in a bull volatile regime. Without that, you can pretty much guarantee that there's going to be, could be sideways action, could just bang around, could do nothing, could sell off a bit, but a true market top, you need the bull volatile. And we got that in February. Okay. January to February, it was pretty obvious that we were in a bull volatile regime. So that's when we started to get these massive moves. Look, this was a 2.5%. Now, right now, 2.5% up move is nothing. And that's indicative of a bear volatile and bear quiet market. Your biggest rallies happen during those regimes. But you just start noticing, and that this is why we do the SQN, because it's measuring, it's averaging the change from yesterday's close to today's close. So from here to here, averaging it over 100 period, and then getting the square root. And that basically tells you what your daily changes are. And when they start to get bigger, then that spikes this up, right? And as soon as we start getting these bigger ones in here, that moves us into bull volatile. And that's saying, okay, this is where it's getting a little wacky and stuff gets scary. Okay. So if you're in bull quiet, you're long, you're sitting long, you're trail stopping, especially as you get into bull vol, you probably move your stop to here, and just trail stop it as best you can. And then you probably, if you're lucky, you got stopped out here. Easy in hindsight, of course, but this is a requirement. So that's some characteristics of bull quiet and bull volatile trading. Now, we are in the, let's go to SP, US 500. Okay, so let's clean off my chart. So we move then from bull volatile, oh my goodness, bull quiet, bull volatile. This is where you want to start taking profits anywhere in here, or lighten your positions. You don't want to start going short because it can stay in bull volatile forever. Look, I mean, it can last a really long time. Hopefully I can get some more data. Looks like that's about it. But you can stay in bull volatile for a really long time before, and this was Volpocalypse. You can see what happened there. Hey, market top. And then, so we're back into bull volatile. Now, again, we had bull volatile here, and it wasn't a true market top. Okay. So just because you have bull vol doesn't mean you have a true market top. It just means that that is the potential of it. And you can wear it out this way too. But when you do have a bull volatile, then that is one of the requirements of a market top. So if you're in bull quiet and you're thinking this is your market top, it's not. You need to have that. That's a requirement. So next time you're trading in a bull quiet regime, it turns into bull volatile, then you need to be a little cautious. Okay, a little less relevant to what's happening today, because guess what? We're in bull volatile. And let me get yesterday's, I'll pull yesterday's email up, and I'm going to share some of the, oops, I want to actually read the email. It's just giving me my data. How do I read it? Oh, I'll just read it from my email. I am a subscriber to my own email, after all. There it is. Okay, I'm gonna. All right, let's throw this in the spreadsheet here. See if it pastes well. Okay. Okay. So what do we know? Actually, this should be on the other sheet because we haven't compared side by side. There we go. Okay. So what do we know about, hey, Bob, I like getting more trades and so I prefer ranges. So ranges work in certain market types, Centra. When we're talking about a bear market, bear volatile and bear quiet, trading ranges don't work as well as the breakouts. So that's another thing that we learn about what works in bull markets and what doesn't work in bear markets. So what we know about trading in both bear quiet and bear volatile regime, shorter time frames work best. Okay, so hourly, 4 hour, 2 hour, 1 hour, 30, 30, 20, 10, 5, 1 minute charts all work a lot better. Okay, snapback rallies on your short positions are violent. What can start drifting, just because what we've seen for the last month or so has been just violent selling. The snapback rallies are crazy. You can be down 5% and then be up 7% intraday. The rallies are actually tradable. And especially when you're in the bull quiet regime, when you move out of bull volatile, when you're in bull volatile, stick with vol breakouts to the downside and then just wait for those setups and you can trail stop those. When you're in a bull quiet, your long positions, you want to hold on to those longer. Now, when we're doing remember when we do the vol breakout, it's like trading the ranges from the bottom to the top of the Bollinger. And then you're taking profit at 1.5R at the midline. What you want to do in a bear volatile regime is, yes, you want to buy those failed vol breakouts to the downside. And instead of selling at 1.5, 1.2R around the midline, 2R to the midline, you can get up to 4, 5, 6, 8R on those trades. So that's an interesting thing about trading the bear quiet regime. It doesn't work that way in bull quiet, and it certainly doesn't work that way in bull volatile, but in bear quiet, it works quite well. So holding on to long positions longer than you think, than you'd expect, is actually a lot better. So on your short positions, you want to trail stop a lot tighter than you think because they can snap back pretty hard. But if you catch like what we did the other day, if you guys were here with me, we basically took what was happening in March, and we traded off of this back test. We went and we traded Grant's. We went and we manually traded the hourly on vol breakouts and fail vol breakouts. And again, longs are closer to 4R profit targets in the bear quiet regime. So that's a really interesting thing to know. And also one of the big things, and this is what I do actually, I just don't trade the bear regimes. So it's fun and it's exciting. And especially when you've never seen volatility like this before, and you've never traded a highly volatile, crazy market like we're currently seeing, it's somewhat addicting to go after that volatility. But And this is the thing that Grant came through after doing. He did from 1962 to 2020. He did that back test, and this is what came back. Strategy that works phenomenally. Normally, all he did was just manually back tested every bear quiet, bear volatile regime over that almost 60-year period. And he was extremely frustrated because even though it was manual back testing, he did 100 trades and made 15%. 15% is crazy. His very first trade was 9.34 R. Think about that. He had one trade, his first trade, up 10 R. Think about how exciting that is to trade. And then you give it all back and then some, and only to come back. And you just do 60, 15%. So it's basically a low trading bear, even the best strategies. So even trading this hourly vol breakout to the downside only was the least performing of all the market regimes, from bull volatile, bull quiet, neutral, bear volatile, or bear quiet, bear volatile. This is the best you can possibly do in the bear volatile market regime. That's the best. And it was an SQN of just under 3. It was 2.98. So for me, I want to trade SQNs of 4s, 5s, and 7 and 8, like what the VBO is in other regimes. So I know what works in different market regimes, and I don't need to just trade the S&P because I tell people I trade the S&P, or I just trade this. What I do is I go find what is in a bull quiet and get to it. And I know what works in a bull quiet. So I just scan everything. I just scan everything looking for my market regimes, and where I have the best returns. I know that bull quiet is by far the best. So even though it's an inverse trade to the S&P, things trade differently. People own this differently than they own the S&P, or than that they sell the NASDAQ or all that. So it's exciting. And if you're not doing a really good job of keeping your statistics, you can get a false sense of security that trading this crazy volatility to the downside is you're actually really good. And you know what? It starts out that way. Maybe the first month you have this massive month, but guess what happens in bear markets over time? You end up giving a lot of that back, quite a bit of that back, because it's just not it's not as rational as a market. You have governments manipulating things. They're stepping in and dropping the interest rate, buying assets. You have forced liquidations. So on the upside, you don't have forced liquidations of portfolio, right? Like nobody's, except if you're short, a perma bear. But if you're in a bull market, you don't have government intervention stepping in saying, "Oh, we're gonna," they may lower or they may raise interest rates, things working, but they're not going to be, adding to the fuel to the fire to buy those things up because the market's going up. So, anyway, if you're not getting the email, you didn't get that email. That was a fantastic. The team has been doing a fantastic job of doing these back tests. Currently, I think they're doing a bull quiet or bull volatile only strategy since 1962. So we can see how that strategy works on the bull market versus the bear market. I've done these myself, so I know what I'm going to expect, but it's always nice to see when you have somebody else looking at what you've done and they're getting the results. So the next time we update this, we're going to be talking about it. Okay. Do we have any questions before I wrap up on the day? And if we do, go ahead and post them in the chat. If we don't, I'm going to turn it loose and go get cranking on moving product across the world during a global pandemic. Let me tell you about a blast of a job that is. So I'll wait for a couple questions real quick, and I'll see if what my DMs are saying. All right, all right. Are you guys good with this time of day? I feel it's a little quieter this time of day. It's about mid session, mid trading session, U.S. markets, and we're closing up on Europe. So I feel like this is a pretty decent time. It allows me to sleep in. I'm an end of day trader here, so I'm looking for bull quiet regime so I can swing trade my breakouts on the bonds if we actually get them. Also looking at Bitcoin still. We're still in Bitcoin here. All right, no questions so far. Double check. You don't have to have questions. It won't hurt my feelings. Just feel like I might as well. Yeah, I can look at a few tickers. All right, XLP. Consumer staples. I mean, everything's correlated, Rocky. So it's going to look a lot like everything else. But what is it you want to have a look at, Rocky, with XLP? So we're in a bear quiet from a bear volatile. Surprisingly, they issued some nice dividends at a perfect time. If you were looking at, yeah, I'm not sure what you're looking for on the XLP. But as far as what I'm doing, I would either be, I mean, you could look at a shorter time frame, maybe. If I'm going to trade off of any stock, I'm happy to trade off of the usually for stock. I'm for equities themselves. I'm looking to buy off of weekly charts, not off of daily or intraday or anything like that. But that's just how I trade. However, yeah, there was a vol breakout. There's also a failed vol breakout. So the potential is up to 60 on the weekly. It may take some time. That's not to say that it won't hit it. So for me, we're in a bear volatile. So I, would expect, or bear quiet. So buying that bottom was good. AR. So you're thinking supermarkets. All I'll say for the supermarkets is they just haven't been hit like the others. I mean, yeah, they did take a 20% haircut, but they're right in the middle. Generally speaking, I don't have an opinion on any stocks. I don't see. I'm not a stock trader, but yeah, everything's in everything. Well, this is in a bull quiet still, but the whole market regime itself is pretty bad. So, bull quiet, you could be looking to get buy any longs, be long this thing. But you're in a highly volatile area, and there could be a lot of contagion elsewhere. But yeah, probably not a bad thing, Rocky. All right, guys. Anything else? Any other questions? Thanks, Bob. I'll keep the sessions going for a while at this time. UUP. I mean, the bullish, I would say I'm looking at DXY when I look at that, or I would look at my basket of. So the way I look at the dollar is I trade the currencies, and currencies don't work off of the SQN model because currencies don't so the thing about SQN is all it's going to do with currencies is to tell you if you're in a volatile or a quiet regime, because generally speaking the manipulation and just the general there's no, like stock, if you're looking at the SP 500, its job is to go higher, and so it conspires to go higher. The S&P rebalances and kicks out the bad stocks and puts in the good stocks to confirm that it's going to continue to go higher. So that's an optimized trading strategy, right? Positive earnings, growth, and whatever is some of the filters that they use. That's one of the most dominant. That is the most dominant quantitative strategy in the market. It's the indexes. So it's a conspiracy to take prices higher. Currencies don't have, like, the dollar is, the dollar doesn't want to be 2-to-1 to the euro. The dollar would rather, ideally we would rather have a little bit of advantage over trade partners. So like USD EUR, so this would be represent the US dollar versus the euro, or is the inverse, EUR USD. So the SQN, all it's going to tell you is if you're in volatile or in quiet mode, and the direction of it is irrelevant because it's over the long term. Yes, it goes down. That's pretty obvious. But the volatile or the quiet is less useful there. So DXY, let me have a look at the dollar. The dollar is bullish. You can see that there is a bullish trend to it. And look, we know that in times of crisis, what does everybody want to own? You buy dollars, right? You sell everything, you go to cash, you take out $1,000, you put it in your safe or your wallet or your carved out book or whatever it is, and under your mattress, and you have cash, right? Then you start thinking, okay, well, what are people going to be interested in? They're going to be interested in gold. So initially gold sells off, just like everything. It's just a massive dump, and everybody throws everything into the dollar, and then things tighten up. So SQN, we're in quiet mode on the dollar. And that means it's all wait and see at the moment. We're at equilibrium, midline of the Bollinger. We're at neutral position on the SQN. So what that's telling us is there's no tell here. This was a big tell that they were, the world there was a lot of fear. The fear is kind of there, but people are, a little less likely to freak out in this sort of scenario. And I'll do it this is my basket of the yen, dollar versus the yen, dollar used to the franc, dollar versus the euro versus the pound, used to the Aussie versus the CAD, and versus Kiwi. So they're the top 7 traded currencies. And right now the dollar is weaker. So people are selling dollars to buy more risk currencies. So my guess is Aussie's going to be stronger. Aussie stronger. Kiwi stronger. Yep, Kiwi stronger. CAD's not, which usually should be. So there's something going on with CAD. But generally speaking, if you want to see if, like right now, people are thinking, oh, we're bullish, and this looks a lot like US 500. This looks a lot like the S&P 500. Okay, so all that is to say, dollar's looking a little bit weaker, meaning people are willing to sell their dollars to buy risk assets. And that means that risky assets are the Aussie, the Kiwi, because that's how you get into the Chinese markets. Okay, AT. Looking at the system building course, would you say that's good for a new trader like myself? I have the profitable trading blueprint and found it to be very helpful. AT, look, I'm biased because I created it, but I created it because I know that's the one that works. I have a tough time creating strategies that the market is interested in, like I know will sell really well. I tend to make products that I know people need. And I know that I'm not going to sell hundreds of thousands of those courses because they're more expensive and they're frankly not as flashy as buying this new Holy Grail indicator. What they do is they actually teach you how to build your own system, test your own system, take the things you've learned and make it your own. Now I include strategies, the failed vol breakout, identifying kind of a mashup of a couple of different strategies that you can each take a look at, just so you're not starting with on a strategy that's fake. A lot of different strategies and systems out there that people put together are very redundant, right? So you'll see some screens where it's 2-3 moving averages, and then Bollinger Bands, and then you have your stochastics, your MACD, your RSI, your ATR, your CCI, and then you're going to have your own Fibonacci's, and then you're going to start drawing Elliott wave lines on it. All that's fake. It's just you're adding new indicators to a chart to help you stop making mistakes. That's typically what happens, and you're thinking, okay, if the VIX is above 50, I'm going to only go short or something like that. And these are just poor ways to do systems. It's technical analysis and people get really excited about it. But what happens if you don't realize that you're putting the same indicator up there? Moving averages, MACD, stochastics, Bollingers, all these things are very, very similar. RSI, CCI, ATRs, all these things very, very similar. ATR, Bollinger Bands, very, very similar. Like if you know what you're looking for, like a lower trending ATR, like if I just took all this off, and this is how I basically trade. Like if you understand how to do price action and you know what characteristics are formed in this market regime on the daily, then you can go down to the 60, and it doesn't work. The SQN doesn't work on an intraday basis. But you can say, okay, well, we know that the failed vol breakout moves to the top of the range last a lot longer than we think they do. Okay, that's cool. Maybe. Okay, and now we're in a potential vol breakout to the upside on the S&P. Okay, I know that. We have compressed vol, but we also have a failed vol breakout setup potential here on the hourly, and that could go down. So when you understand the characteristics of what is going to work in those different market regimes, you then understand. And when you go in here and this is exactly what you're going to learn in the systems building course, AT. You learn how to fill this out. You learn how to do a real back test, and you learn how to get in here and get all these numbers. And you'll know that this is a worthless strategy to trade, because it's not going to be worth your time. It's going to make money, but it's going to be so much work and effort to get there that it's not really worth your time to do it. It's more work than it is useful. So AT, I highly recommend, especially look, if you're home with a family and like got the time to do the work on going through the systems building course and building your own strategies, and you already done the blueprint, so you understand why you wouldn't have bought this thing yesterday. You would have waited to get pulled into it. So you already have an advantage. Use those tools from the blueprint, the profit trading blueprint, to help guide you in the systems building course. I think you're set. Anyway, I agree, would be the logical next step forward. Rocky, have I been surprised by the price action gold? So Rocky, no, I wasn't. This is exactly, so just FYI, I've been trading since 1999, and I've gone through what happens when markets dump. Okay, I know what happens, and what is that? It's when the markets start dumping, everything gets sold. Everybody has to sell because you're getting margin calls on your Teslas and your the margin AT. Absolutely. If you got the time these days, you should be putting in 4 hours of back testing a day. Get on it. And actually you can join, if you do the systems building course, the back testing mastery course, when you complete it, then we're doing the Trader Thunderdome mentorship, where we're doing 4 hours a day every day of the manual backtesting, building this stuff up, learning these things that I keep sharing in the emails. So instead of just getting the email and saying, oh, that's useful, you'll actually understand what it is and you'll be able to provide action. So gold, just like anything, when markets go in chaos, everything gets sold. It's just margin margin calls left and right. People are scared. Everybody talks about, oh, market sell off, you go long gold because everybody's scared. It takes time. So what happened is everything got sold here, just like Bitcoin, right? Everything got sold at the same time. It was just, everybody's like, oh yeah, Bitcoin's a perfect hedge for what's happening. And everybody's like, yeah, see, Bitcoin's still up on the year. And, it was 3,500 to 10,000, I think, or not 3,500, 6,300 to 10,000 in February. And all of a sudden, everybody's getting margin calls. Everybody is worried. Suddenly you need to pull money out. You're worried that the bottom's, everything's dying, and the correlation happens. Now, the price of real gold, if you go to a gold collector, is not $1,650 an ounce. It's more like $2,500 an ounce right now, because the physical gold is what people want. They don't want to own a futures market of gold, because they're worried about is traders get margin calls, exchanges get shut down. Like, they just can't handle the traffic. There's a lot. But after that initial shock happens and people get positioned for what is happening in the markets, then then people start realizing, oh, we need to buy gold here. And then you got your double bottom pattern, or you've got the failed vol breakout long in a bull quiet regime. It snapped out of it, but look, you're right back in there. So the trade would have been the failed vol breakout long down in the 1,500 area. And because we're in a bull quiet, you're probably exiting around the midline here. You're not looking to catch this extra move up here. And that was, that's a, 1.5, 2-hour trade, at least maybe 3-hour trade up to here. As we're back in bull quiet, now we're just looking, we can take these off again. And now we're just looking for any reason to buy. So we have bull quiet. So we'll probably do this, up, pull back, up, pull back, up, pull back. And remember, the thing about bull quiet market regimes is you want to look for excuses to buy. Okay. So right now, excuse would be a buy stop above here. So a move above 1678.60 on the futures would be that. Now, tomorrow, it would be that, right? So it's very simple for that. Any other questions, guys? That was some good questions. So the physical gold, yes, Rocky, people are seeking it, but understand that a lot of people expected gold to rally hard when the market started selling off, and it did a little bit. But when things started to get uncomfortable, it got dumped just like everybody else, just like every other asset. That's just the way it works. A little bit longer session today. We went for a full hour. I guess any other questions while I'm still here? Good questions, everybody. I think that's about it then, huh? I will wrap it up here. Again, if you are not subscribed to the emails that I keep referring to, you should go over and let's see. Still, this is the trade I'm looking at. Go sign up for the email at christover.com. If you are, then awesome. Love seeing it. And I think that's it. I think we're done on I think we're done on questions here. All right. That's it for me then, folks. I'm going to go ahead and cut it short. Hey, what's up? As always, I'm going to do my famous pose at the end.